And it's going to be, in fact, I'm working with Tom Lakatos on some of the part of the regional meeting presentation. And it really should work out to be a nice meeting. We're going to have the regional meeting from 10 to approximately 2:30, and then from 3 to 5, we'll have a short WMP only meeting, which will include the annual compliance meeting from Deirdre. And then we'll have cocktails and dinner and some recognition from 6 to 8. And anyway, we're really looking forward to it. Lincoln is putting quite a bit of effort. Joanne McKelvey has said she's going to be there. Dennis Hauser will be there. Tom Lakatos. I think Tyler Mangum is going to be there from Advisor Consulting. I think that's the last heard on that. And then I can't remember. Oh, Deirdre, of course, and then I can't remember who else. But anyway, it ought to be a really good way to start the year, and we've got it in a good location in Newport, so it ought to be a lot of fun. I'm sorry? Oh, the date, January 17th. So again, you know, we hope you can all attend. Please check with Angie or me, and we'll be glad to help you get registered and set up. Well, the other thing, let me mention this. So I think we mentioned that we have a new employee here at Wealth Management Partners, a new staff person, Nellie DiPietro, and Nellie is housed at the Lincoln home office. Now Nellie's here today. She's here this week for training. She's been in training for about a week or two now, and she's just doing fantastic. We think this is really going to elevate our service level. We've already found that it's very beneficial for her to be there. You know, anytime we have an issue that we can't seem to get a response, or we're having trouble getting the response we want, it's awfully nice to have someone that is a WMP employee that can walk down the hall and speak to someone. That's already proven to pay some pretty good dividends for us. So we're excited about having Nellie on board. If you haven't already, please send her an email or give her a shout and introduce yourself. And you know, over the next few weeks, we'll be expanding her role as she gets trained, and be on the lookout for some announcements on that. And then last but not least, so year end, always there's a whole bunch of stuff to do year end. One of the things I'm really pleased to see is all the year end items have been filled. So all the CE courses, all the license renewals, all the things that are kind of that last, you know, minute struggle for all of us. You guys, all of you, you've done it, and I can't thank you enough. This is great. So everybody got it done, and we are completely done with all of our year-end requirements when it comes to, you know, compliance and things of that nature. I want to bring your attention, though, to a couple of things that have been sent out recently under compliance news. So one is annual advisory contact. The other is the advisory accounts with high cash concentration. Please be on the lookout for this. And one of the things you might want to do is go on to My Reports and see there if you are someone, first of all, you'll get communication on all of these items if you are someone that needs to address this issue. But the reports for the clients that you have that might be affected by these issues can be found in My Reports. So please take a look there and see if there's anything there. It'll give you the accounts, and the clients, and what the problem is. Please read these emails carefully, or these memorandums carefully. There are some really good tools that Lincoln has developed now that you can use to make this process a lot easier. But if they are important things for you to address. If you don't, then at some point Lincoln is going to reach out to your clients on your behalf and make sure to make sure that, you know, the cash concentrations are appropriate and that they have had at least an annual visit from you. Most of the annual visit requirements come as a result of not enough trading, usually no trades in the last 12 months. So it's usually people that are managing their own money, and maybe there's an account that for whatever reason you didn't have any trades this year. You have to explain that in some way. So please read those carefully. Also, there is a recent communication on 12B1 refunds. So this has to do with, in fact, the memo came from Deirdre. And again, if you go into my reports, there should be a report on any 12B1, any clients you have or accounts you have where 12B1s need to be refunded to those clients. This is something that came from the SEC audit. Lincoln went back, I think this one goes back to 2013. And in any event, it's basically qualified plan accounts where the 12B1 fees should have been refunded, and for some reason they weren't. So please take a look at that memo carefully. If you need help with that, contact either me or Angie. We'll be more than happy to help you with it. These refunds are going to be made here pretty quick, and there won't be any financial hit to the advisor, so there won't be any chargebacks or anything of that nature. They'll simply be a credit made to client accounts. If that account has been closed, then the clients will get a check. So anyway, please keep a close eye on that and make sure if you do have any issues related to those memos that you address them as soon as you can. All right, well, listen, does anybody have any questions about that stuff? All right, then. What I'm going to do now, then, is introduce Rick Mahalchik. Rick, as all of you know, all know Rick well, I know, and Rick and PSF, just had another great year in insurance sales, and it's a really nice advantage that we have as a firm, that we have both a securities business, but also an insurance general agency with many, many years of experience to help us with that risk management part of our relationship with clients. So I asked Rick if he would join us today. He's going to introduce Damian Glennon for us as well. And they've got a nice presentation to go through, and hopefully you guys can find some real benefit from their presentation today. So, Rick?
All right. Well, thank you, John, and good morning to everyone, and good afternoon to some others. I know we've got people all over the country. John asked us on this last call to just think of some ideas that we've been using throughout the year, or things that we've seen going on. So we're going to talk about, and I'm going to turn it over to Damian shortly for the next 30 minutes, two ideas, but one is more on planning side. If I take a look at this past year, and we've had a tremendous year, we're up over 30% over previous year, one of our best years in the last 4. We've seen an absolute uptick in business owner planning, executive planning, and an uptick in design using split dollar. And most recently, where we've had a number of cases, and I know Damian's working on some as well, is in the loan regime side. I thought it might be helpful to kind of highlight and talk about the Harbaugh plan here, and I'm not going to take any fire away from Damian, but if anybody is obviously in tune with anything to do with college football, knows about Jim Harbaugh and the University of Michigan and what they did there. But it's not unlike any corporation, nonprofit, credit unions, and other executive benefits that they're trying to do to retain or add additional benefits to people. So on this side, Damian Glennon, as part of our advanced planning desk, one of our resources, along with Paul Stevenson, our tax attorney, are available to all of our PSF staff, our advisors, as we get into case consultation, talking about different ways and design to put our best foot forward on planning. So what I'm going to do is I'm going to turn it over to Damien to get into the more of the focus is going to be on the split dollar and understanding that, and then I'll end it with a sales idea in regards to buy-sell planning. So again, keeping the focus on business owner planning and executive benefits is where we've seen the largest growth this year and also heading into next year. So with that, I will, Damien, I will turn it over to you to get into the first part of the agenda, and then we'll wrap it up with myself.
Definitely. Good morning. Thanks, everybody, for jumping on. I know it's a busy time of year. As Rick said, my name is Damien. I work in the Advanced Marketing Department at Capitus Financial. So we work with financial advisors to help identify and implement, business and estate planning techniques that are tax efficient. So view us as part of your plan. Yes.
Sorry to interrupt you. Hey, make sure you share your screen. That way, when you get into it, the group, they can
Absolutely.
see Yep. Sorry about that. Go ahead.
Yep, absolutely. Here we go. So can everybody see the PowerPoint?
Yes. There we go.
Yep.
Okay. Thank you. So specifically today, we're going to be talking about retirement income planning for key employees, and specifically something called the equity split dollar. It goes by a lot of different names out there. One is the Harborough plan. And before we get into the nuts and bolts of the split dollar itself, we just wanted to go over some basic retirement planning vehicles that are typically implemented. A lot of this is going to be very basic for a lot of you guys. Obviously, you know how qualified plans work, but it's important to see what the advantages and disadvantages are to qualified plans and the limits on them. So when we compare them to the equity split dollar, you can see what some of the benefits are. So we're going to do a brief overview of qualified plans. We're going to talk about what the profile looks like of a client who is appropriate for using life insurance in retirement planning, because split dollar does use a life insurance chassis, and then also how the split dollar interacts with all those. And when I talk about qualified plans, I'm really talking about defined contribution plans, right? Because there's not a ton of defined benefit plans out there. And within defined contribution plans, we're really talking about the employer matching contribution part of it, because those are the dollars that are going from employees to participants. And the advantage of that is pretty straightforward. That the employer gets a current tax deduction and the participant gets tax deferred growth. The disadvantage is that we know a qualified plan is an ERISA plan. It's non-discriminatory. So you depending on the census, depending on how much income and the ages of various participants, and what their income is, the matching contributions can be relatively significant. It become very onerous. And it can be a messy way to get dollars in the hands of key executives who you want to benefit specifically if you have to, make a significant contribution to rank and file, obviously. You do have to administer the qualified plan. You have to have a TPA. There's reporting requirements. That's not a huge hurdle by any means. But on the taxable benefit side, I want to spend a bit of time there. Obviously, a lot of people are very deferred asset heavy. They have qualified plans, annuities, deferred comp. And we know what the tax environment is today. We're in a relatively attractive tax environment. We have no idea what the tax environment is going to be when you retire 15 or 20 years from now. And that's one thing we don't have a lot of control over. We have no control over what the federal tax code is going to be at that point on the income side. You could move to an income tax-free state, but if you're a resident of the U.S. and you have a qualified plan, you and your heirs are ultimately going to have to pay the income tax on that qualified plan. And it's a big uncertainty. If you use a round number, you have $1 million in a plan, your tax rate's 30%, you have $700,000. If you have $1 million in the plan, your tax rate's 50% in retirement, you have $500,000. And that's a lot of uncertainty. And in financial planning, we like to lock down as many variables as possible. There's obviously also contribution limits in qualified plans for the participant and, the matching contribution from the company. So there's a lot of restrictions there. And ultimately, there are required minimum distributions. The IRS tells you when you have to take money out and how much. You can't defer it forever. And when it comes to wealth transfer for your wealthier clients who don't need that qualified money because they've been so successful, when somebody inherits that comes with a zero basis and is fully income taxable. So we all know that, but I wanted to point that out so we can compare and contrast the split dollar to qualified plans. By no means are we recommending that you do split dollar instead of qualified plans, but we just want to compare and contrast some of the benefits to a known planning tool. So now we're going to go over, life insurance and how life insurance works in retirement planning specifically. There definitely are some parameters and profiles we need to fit. One is that when you're using life insurance as a tax efficient accumulation vehicle, you really need to be under age 60. and the ideal market's probably 30 to 55. And the reason is we need to leave the money inside the life insurance policy for at least 15 years before we start taking money out. If you want to take the money out in 5 years, life insurance is not the investment vehicle you want to use. It typically takes about 5 to 7 years to break even. But if you hold the life insurance policy for over 15 years, 20 years, we can get the net cost of the policy of the death benefit down to about 1%. So we can get the net drag on the policy cash value very, very low, but it's a long-term investment. The prospect or the client has to be comfortable with equity exposure, or market exposure, and has to really believe in long-term investing and sticking with it, because with these typically looking to variable or index universal life, so they're market-based products, they give us the most upside potential. You could absolutely do it with whole life, but there's less flexibility with the whole life chassis, and there's also less investment flexibility. You're investing in basically the general account, or that you're relying on the dividend of the company, whereas with a variable or an index policy, you have a lot more flexibility and potentially more upside, but also a lot more flexibility in the product chassis itself. I'm going to reiterate this again. We never recommend using life insurance as a retirement planning vehicle unless you've already maximized your more traditional retirement planning vehicles, like your qualified plan, non-qualified brokerage account savings 529. This is a supplemental plan on top of all that. So this is definitely not in replace of. This is an added benefit. And again, clients who might like this are clients who are looking to put away dollars on a tax-advantaged basis without the restrictions that exist within a qualified plan. Because again, you have those funding limitations on a defined contribution plan. Again, we don't see a lot of defined benefit or cash balance plans out there, even though they do exist. So you have funding limits. There's no funding limits with split dollar, with a life insurance policy. There's no minimum required distributions. So that money, when you're taking it out, it's not increasing your tax rate. You're not reporting it on your tax return. Nobody really sees it. It's a personal asset of yours, and it provides a lot of flexibility. And if you ultimately don't need that money and you pass it on in retirement to your heirs, then the heirs get that death benefit tax-free. When you compare it to a qualified plan, again, just as the most typical retirement planning vehicle out there, your heirs inherit it. They can do a stretch IRA, your grandchildren can do a stretch IRA, but it's a 100% taxable asset. So, using qualified plans with this type of plan can really help diversify a client from a tax perspective. Everybody talks about investment diversity. Some people talk about tax diversity, but I don't think it's talked about enough, because you really want to control your own destiny in deferring, putting all your money in deferred assets, qualified plans, deferred annuities, non-qualified deferred comp really opens you up to a lot of uncertainty in the future. And again, you really don't have any direct control over what that income tax environment is going to look like in the future. And on the business planning side, you really do need to have a business that obviously wants to, implement some type of executive benefit plan. The next slide is really just what the ideal business sponsor looks like, or the profile of the business sponsor. You need to have a stable business that has profits and cash flow. When you're funding a life insurance policy to accumulate cash, you really don't want to be skipping premiums in the early years. Once the policy is funded and off the ground, you could skip premiums. There's flexibility to lower death benefit potentially, but you don't want to be skipping premiums in the early years. And you do need to, once you put those 5 or 7 or 8 premiums in, you want to let that money grow for 15 plus years. So you do need to have a stable business. You don't want to be jumping in and out of this technique. The other one is you have to have highly compensated executives that you actually want to benefit and you can afford to put money away for. That's kind of a given. And again, we keep talking about this taking a long-term view. You need to put this money away, and it needs to sit for at least 15 years. We get a lot of people who, they want to use life insurance as an investment vehicle at 65. Maybe that works if you can put the money away till you're 80 and not take money out. But most people want to be taking retirement income, before that point. So that's where we come up with that, 30 to 60 age range, or 30 to 55 age range. This could be a very powerful planning tool, when deployed in the right circumstances. And again, I'm going to say it again, this is the supplement qualified plan contributions. This next sheet, this next page, I'm really going to call my terminology page, because what I find personally very frustrating about split dollar is people call it all kinds of different things. In Lincoln has a great program called Life Comp, but they call it all kinds of different names to try to make it more user-friendly. And for me, it can become very confusing because it's, unless you completely understand the mechanics of it, it's difficult to see what's really being accomplished and what kind of split dollar we're talking about. So to be very clear about it, the technical name of what we're going to talk about here on the point of this call is called collateral assignment loan regime split dollar. It could also be called equity collateral assignment loan regime split dollar, or what we've seen here, which was implemented in 2016, the Harborough plan, for the head coach of the University of Michigan is a very significant plan that's been implemented in 2016. A lot of people are referring to it as that, as almost as a marketing pitch, because it's a notable figure, it's a notable educational institution, and it's something you can point to show that that this is being done out there. I've reviewed hundreds of these split dollar plans from hospitals. Verizon does it for their employees, IBM, AT&T, PricewaterhouseCoopers. I mean, there's a lot of large companies that are public and private, for-profit and non-profit. This works for non-owner key employees of all those types of institutions. So it's very applicable. We just want to give you ideas that, can differentiate you from other advisors so that you're bringing unique ideas to your clients that are very powerful and income tax efficient. So we can provide those benefits. And again, we're here as your support. We can speak with the client on the phone to go over the concept. We can educate you about the concept behind the scenes. We can put it on paper. So we're here really as your planning department. View us more as your planning guys than your insurance guys, whether it's business planning or estate planning, charitable planning. We're here as a resource for you. So this next page, we're getting into finally the nuts and bolts of what equity collateral assignment split dollar is. And what it is, it's an executive benefit. So it's an executive benefit plan that's sponsored by the company, by the nonprofit, by the credit union, whatever it happens to be. It's a fringe benefit. So it does have a life insurance component. The main objective of the split dollar is really to provide tax-free or tax-advantaged retirement income, but it also has very, very strong employee retention aspects or golden handcuff features to it, which we'll go into. But mechanically, what's happening is the employer is loaning premiums to the executive. Because it's a loan and not taxable compensation, the executive doesn't have to pay income tax on that loan that's being made to them. So if you loan $100,000, you're not picking up $100,000 of taxable income. You're only having to recognize an interest component on that loan each year. It's called the applicable federal rate, without getting into the weeds. It's published each month by the Treasury, but you're just paying a little bit of income tax friction along the way based on that interest component on that loan principal. So what happens ultimately is that the employer is loaning dollars to the employee. Those dollars are being invested by a policy owned by the employee or the executive, and they're accumulating. So if you loan $500,000 out to the executive, they invest it in the policy, it grows to $1 million. At some point in the future, two things can happen. Well, three things really. One is you could never repay the loan, keep it outstanding for life. I'm not a big fan of that solution because it creates a lot of uncertainty, a lot of ongoing interest rate risk. The two that are more frequently used and that we implement are two things. One is the executive can repay the company the principal on that loan. In that example, $500,000. We'll go into a real life example we sold recently next. But the executive can repay the company that outstanding loan. The assignment is extinguished in the policy, and the executive has any growth that occurred in the policy, and they can access that money income tax free. And there's not many ways you can shift dollars, not outside the income tax system, but you can shift dollars out to an employee that are not income taxable or that have a very small income tax component with interest. So that there's some techniques out there that are aggressive that might get your client audited. They could be listed transactions. This is a very bread and butter, simple technique. The current regulations have been around since 2003. So they've been around in their current form for 15 years. Again, this is used by very large, organizations. There's nothing aggressive about this. We would never show you guys anything that's aggressive. This has, something that is codified. We design it so it has a good certainty of result. As far as the documentation, you do have to have a split dollar agreement. Sometimes there's an employment contract that goes along with it, but it doesn't rise to the level of administration required on a qualified plan, where you definitely need to bring in a TPA, to administer it. This next page is, we kind of inserted a simple 3-page presentation that we use to show the concept. This is just a graphical, a flow chart of what's happening mechanically with the split dollar. So the company's loaning annual premiums to the executive. The executive is then taking those annual premiums and paying them to the insurance carrier. What the executive gets in return from the insurance carrier is obviously a death benefit and cash value, or tax-free income from the policy in retirement. At some point in the future, the cumulative premiums are repaid to the company. That can be done with a policy distribution if the policy's been enforced long enough. And along the way, there's a little bit of income tax friction that's paid to the IRS. And I'll get into a real-life example that we did for a credit union recently. This next page is redundant from what we already spoke about, but this is just part of our 3-page split dollar proposal, so I don't need to go through this, but this is just a little summary page we put in here that shows what the profile, what the benefits are to the employer, to the executive, what's happening, that type of stuff. We don't need to really rehash that right now. The next slide here is an example of actually what's happening, so I can show you what the benefit is to the executive, what the benefit is, in this example, to a credit union. It could be a taxable corporation, it doesn't matter, but this was for a president of a credit union. They contractually owed him retirement income. They had done this equity split dollar in the past. They wanted to implement it, for this current CEO also. So we have a $300,000 premium that was loaned for 8 years. As a lot of you know, when you use life insurance as a accumulation vehicle, you do something called a max non-MEC premium. So we're putting in the maximum premium possible for a given level of death benefit. But with the objective of creating cash value, not death benefit. But the death benefit is secondary, and it is there. But we put in $300,000 a year. That drives about a $4 million death benefit. If you go all the way to the right 3 columns, one says annual income to executive based on long-term AFR. As you can see, the executive isn't picking up ordinary income on that $300,000. They're simply picking up the interest rate as a taxable income on that. So currently, the AFR is about 3%. We always project these conservatively. We ran this at 4. That's 30% over what the current rates are. As each of these loans is made annually, it's going to be loaned at the prevailing rate. We show it at 4, again, to be conservative. This was in Texas, so we showed a 40% tax rate, which, in Texas is conservative. In California or New York or Massachusetts, that could be on the low side. But for the state we ran this in, it was a conservative assumption for this president. So you can see the tax friction in year 1. He has $300,000 working for him, and he had 4 years of tax friction. I mean, that's pretty incredible. You have that are invested working for your benefit for under $5,000 of tax friction. As additional premiums are loaned each year, obviously the interest component in the tax begins to grow. And in the rightmost column is what you want to pay attention to there. That is really what the actual dollar tax hit is to the executive. It's $4,800 year 1, $14,004 year 2. Then we fast forward. Beginning at age 66, we start giving the president $60,000 of income a year from 66 to 80. So he gets $900,000 of income. And I'm going to fast forward one more time to age 70, and this is where everything kind of culminates, so you can really see what the benefit of this design is. You fast forward to age 70, year 13, we take a distribution from this policy. The credit union gets repaid their $2.4 million. All along the way, the credit union had an assignment in this policy equal to their cumulative premiums. So yes, the credit union had a negative cash flow, but they also had a balance sheet receivable that's equal to, the premiums that they loaned out. You can also design it so the credit union is paid interest on it instead of forgiving it, in which case they can actually have an accruing benefit, but it kind of requires a higher premium than this. We wanted to keep it reasonable. So what happens is the credit union has an account, a balance sheet receivable the entire time. They're fully collateralized. At the end of the term here at age 70, year 13, we repay the credit union their money. They get all their money back. Think about that compared to a qualified plan. They make those matching contributions, not that there's anything wrong with matching contributions, but from the employer's standpoint, they don't get those contributions back. With this, ultimately, they have a balance sheet asset. They get their contributions back. And what the executive gets in retirement, he gets $900,000 of tax-free retirement income. And even after that, since, again, we build this conservatively, we overfunded it, in year 24, age 81, there's still about $500,000 of cash value in this policy. So what the executive got out, he got out $900,000 of income. He has $500,000 of cash value, so he got out $1.4 million, and all it cost him was $326,000 in tax. We basically took his tax rate from 40% down to 20% completely legally. So we basically cut his tax rate in half, and that's the real power of this technique. In addition to that, there's death benefit. If he were to die prematurely, the credit union or the corporation gets their money back, and the executive gets any death benefit in excess of that loan repayment. In the beginning years, this is about $4 million. So you have a $4 million pre-retirement death benefit, a death benefit in retirement that it minimum is $800,000 growing to, $1 million or more, and you got $1.4 million of income out of this policy for only $326,000 of income tax. So it's really a powerful technique. We've been using it a lot more over the last 5 years or so, probably because the market performance has been good. Companies have really been trying to reward and retain their key employees that they've had. Throughout the downturn we had, companies had key employees. They weren't providing a lot of these executive benefits. Over the last 5 years, these executive benefits like this have exploded. And we're seeing a lot, the economy's doing well, obviously, but these companies want to retain these key employees. It's been a very competitive, labor market. You see some of these statistics that, there's been the most people resigning from their jobs to take new jobs at higher compensation than there has been since, I think it was 2001. So they know there's a lot of turnover, and businesses can't afford to lose their key employees, or sometimes in this case, they're contractually obligated to put some retirement plan in force for their president. And this is a way, what's your other option? You bonus the money, the company gets a deduction today, the executive gets taxable income today on that bonus. The guy could leave next week and they lose that money. This gives the company control over that money, and it provides that incentive for the executive to stay. The next sheet we have is a piece out of the Harborough split dollar plan to give you an idea about how significant some of these plans are. This plan began in 2016, and as long as Harborough continues to be the head coach, they're going to offer him $2 million a year they're going to pay into that insurance policy on December 6th. But it says right under Section A, Section A schedule, that if he is not the coach and performing his duties as head coach on that date, on December 6th, he's not going to get that $2 million contribution. And think about the significance of that. Even if you're making $5-6 million a year, you could potentially be foregoing an additional benefit of $2 million. And unless you stick with it, you're not going to ultimately get the benefit. This is a long-term plan. This has to be for people who can afford to put those dollars away long-term in addition to everything else that they're doing currently. But when you have that right fact pattern, there's really nothing that can be as tax efficient, because how else can you lower somebody's tax rate legally? This is black and white. There's nothing aggressive about this. But we just wanted to give a quick overview of this concept. We're available to help you identify prospects, model it behind the scenes, speak with the prospect. Paul is a non-practicing tax attorney. He could speak with the client's tax counsel, their CPA, their tax attorney. Nothing that we're going to do is aggressive. Nothing that we're going to do is going to put you in a compromising position or embarrass you. We use all the same techniques that are used by the client's tax counsel, whether it's business or estate planning. We're just great at putting them on paper to show the impact. Attorneys are great at designing and implementing these. They're not too good about putting them on paper and showing them, here's what happens. Here's your income tax savings. Here's the additional inheritance to heirs. And with the split dollar, that's another major benefit, is that if you don't use this money, you could choose not to take income out of it except to repay the company or the school. You could pass that death benefit on to your heirs tax-free. We could lodge this inside an irrevocable insurance trust to have it outside your taxable estate. Those are things you can't really do with a qualified plan. I know we've went through a lot here, but does anybody have any questions or comments or things they've seen with this design?
Damien, thanks on that. I'm not sure if anybody has any questions, or if, in the interest of time, I'll jump into my section. It was, and then we can hold it up to any questions at the end. But exactly what Damien said, and many people on this phone see that. I'll share my screen now. is that you got the attorney drafting the documents. We always see the attorneys that draft the documents. You got the CPA who's worried about costs, and no one's really necessarily looking at the executive as to the benefits of the executive besides what they've already done for all the employees and the masses. This last sales idea, the reason why buy, sell, and then split dollar, why would we talk buy, sell planning and a sales idea after a split dollar, which is a relatively more advanced topic, and that is because many times the entry point into these business owner opportunities that result in the executive planning on using insurance for its tax advantages that we see is through that simple question: do you have any document, Mr. Business Owner, in place that formalizes your business transition plan? And so it's through that discovery: do they have anything in place? What is it that's in place? Do you want us to review it? And then we start getting into those next questions about benefits and executive benefits on that side. And this one in particular, buy, sell plus, there's a lot of wording here. Don't worry about all the wording here. This is really talking about how disability is often overlooked. If you take a look at any shareholder agreement, buy, sell plan, it addresses the fair market value formula that's going to be used, that might be used. It talks about which parties will have the first right of purchase, in that document. And it also addresses what occurs if a death, a disability, or a sale or retirement occurs. In our world, we often see an advisor or an agent or anybody first just bring it up with the idea of life insurance, and life insurance only. And many times if the CPA is involved, it's going to go term insurance because they're looking at it from a cost and or a client or CPA attorney understanding. They know what term is. It's cheap. It addresses the fact. But we often overlook the disability part of it. And this is one that, if it's going to be term insurance, might help you supplement your case to increase the overall premium, but also protection for the client, but also overlooked. And that is, if you buy, sell plus is nothing more than, instead of just looking at a typical disability buy, sell document, a disability buy, sell, which has a 12-month elimination period, which means that business owner is going to be disabled for 12 full months, that during that time, the owner is not going to be generating any income or potentially receiving any income. And then we get into the shareholder agreement. What does the shareholder agreement say if you're disabled? At what point will they stop paying you on this side? So this buy, sell plus is a way to provide income while they're waiting for this ultimate buy, sell disability to pay out. So the next goes into an illustration. If you take a look at what a typical buy-sell plan is, it's a 12-month elimination period, at which time that lump sum is going to get paid out to the business owner or the business. This is the idea of supplementing a key person policy while the business owner is disabled, so there's cash flow. So in this case, we take a 90-day elimination period on a 9-month benefit period, key person policy. It's going to pay $90,000 a month. A maximum of $90,000, but $10,000 a month. It's only going to cost $1,000, but it's going to be paying while that business owner is disabled, because they may come back. And if they come back under that 12-month period, the typical buy-sell plan with a 12-month elimination period never would have paid. Obviously, the life insurance never would have paid. But this is a way to supplement income during that time for a very inexpensive supplement. So for $1,000, they can get that benefit. And if we look at the next slide that you see right now, this is the traditional buy-sell. I've got $1 million value. It's going to pay out after 12 months, but I've got to wait 12 months. So although that premium's $3,300, by me just adding another $1,000 of premium, I've got cash flow during that 12 months. So instead of just looking at life insurance only in buy-sell planning, definitely take a look at disability. But in addition to disability, looking at this type of supplement, which makes common sense, because instead of the business owner simply waiting that time period. So, in wrapping that part up, it's one policy. So what's nice about this from your standpoint, it's one application, it's one exam, we combine the benefits, and when we issue the policies, it's done after that one application. Sharing the exam, you don't have to worry about anything else. And they're going to have a, ONOC waiver of premium. It's for the period of time that you need it. standard policy. This is through Lloyd's of London. And underwriting requirements, as many of you are aware, you know, you have the medical, you do have the financial that you may not have on the life insurance, and then the questionnaire. But to wrap it up, just to look at the side-by-side comparison, on the left side, I've got my traditional $1 million 12-month waiting period for $3,300. By adding that $1,000 key person policy to have supplemental cash flow, I increase it to $4,390. And then if I had term insurance, whatever that premium is on top of that, that makes it a more holistic plan overall on that by itself. But then it's using that discovery, those conversations to get into, besides have you put anything in place to formalize your business transition plan, do you have anything in place for the executives, the business owners, for their retirement benefits above and beyond what the you've done for the rank and file or the employees? So with that, that wraps up mine and Damien's. If anybody has any questions of Damien, what he went through, or wants to shoot me an email after, feel free. But I'll open it up if anybody has any comments or questions.
Hey, okay, it's John. What to do here? This is a lot to absorb, but I'm really glad we did this because I think it's a really good reminder for everyone of the quality and the depth of both the support and all the experience that PSF can bring to your client relationships. So this is a really good reminder of that, I think. And I know a lot of times these concepts are a lot to digest. What we're going to do is we are going to send out the deck for all of you to review. Obviously, if you have any questions, we've got contact info here for you. Please be sure and reach us. We really have managed, even through the transition of our businesses in the last couple of years, to keep the business together, to keep our culture the same. We all benefit from the fact that we work together, that we have a really strong wealth management and insurance, securities platform, but so much of your competition doesn't have what PSF offers in the way of incredible support for the risk management part and also the benefits part of wealth management and the advice you give to your clients. So please take advantage of it. I feel like sometimes this is an area where we don't probably do enough business on the WMP side of the house. And there's so much more opportunity, not just for you, but there's a real, I think, necessity that these subjects get brought up in your client meetings. They all need this kind of support and help, and it's important that we have those conversations, that you have a good resource behind you to get them done. So without any further ado, I think we'll go ahead and say goodbye for this year. I can't thank you all enough. Your business is greatly appreciated. The professionalism, it's just a joy to work with WMP and with PSF. I hope all of you enjoy the holidays, and we look forward to seeing all of you in about a month in Newport. So thanks so much, and again, enjoy the holidays. Take care.
Thank you. Thank you. Take care.
Thank you very much.